first like to say a few words about the Common Fund for Commodities itself, because the organization may not be known so widely as the larger international organizations. The CFC is an international financial institution that has been established under the aegis of the United Nations Conference on Trade and Development. The organization has just celebrated its 32 years of operations, and we look forward to continuing this. The headquarters of the organization are in Amsterdam in the Netherlands. The CFC does not have regional offices or regional representations. The organization is quite small, and we have a very compact secretariat in Amsterdam, established in 1989. Currently, the membership of the CFC counts 101 member countries and a number of international organizations who are institutional members of the CFC. The operations of the CFC target the member countries of the CFC, so a country needs to be a member to host a project financed by the Common Fund for Commodities. The CFC possesses quite a lot of technical competence. So as I mentioned, 30 years of project experience, over 440 projects financed, and the total project cost of 798 million, of which the CFC has directly contributed 353 million, and the remaining 455 million were contributed by the project proponents themselves and by the co-financiers. We always look for co-financing, but we'll say more about it. The projects the projects financed by the CFC covered 68 or so commodities in the past. We can deal with almost any commodity that is relevant for poverty alleviation, excluding the energy commodities, oil, gas, and some others. Also, the CFC had operations in over 90 countries. So basically almost any of the CFC member countries has benefited from one or more projects financed by the CFC. A bit on the overall approach of the CFC. So why is the CFC targeting commodity sector? What's so special about it? It is understood, it has been the subject of much academic debate in the past, and it is now understood that reliance on primary commodities, the commodity dependence, is a symptom that is a root of poverty of over 2 billion people. It's a symptom of certain conditions that people in developing countries are facing, and over 2 billion people are affected by this. And the CFC project always target fair, equitable livelihood for the people who depend on primary commodities for a large part of their income. Also, as we are facing the challenges of the pandemic, the CFC looks at projects targeting green recovery, nutrition security, adapting the new models that are effective in addressing the problems of the commodity value chain, and looking for all the elements of sustainable development, including inclusiveness, gender lens, and innovation, as well as creativity at the grassroots level, at the level of the primary projects. I'm advised that my sound is coming a bit low. Is that the case? Can somebody, some of my colleagues, tell me if I need to do something about my sound?
For me, Andre, it's pretty clear.
Right.
Okay.
Okay.
It's also fine, Andre.
Okay, thank you very much. Then I will not fiddle with my sound, and I continue as we are. as already mentioned, multi-stakeholder collaboration is essential in the operations of the CFC. As you have seen on the previous slide, the CFC always finances part of the project costs, and we expect the development partners, the project proponents, to make a contribution to the project development. And this has recently been formulated as the additionality, partnership, and innovation framework for the Common Fund for Commodities, based on the vision and mission of the CFC. As you can see on the screen, the CFC is aspiring to be a leading partner in operationalized activities for commodities in developing countries. And in this, we very much count on your proposals on joining forces with other organizations undertaking operations in the commodity sector that could benefit from the involvement of the CFC as well. So here I will conclude the part related to the broad big picture of why the CFC is there, what the CFC is trying to achieve with its financing for projects. And the call for proposals is the foundation of our project work. So this call for proposals depends on you, and it feeds into this broad vision that will be achieved through a certain process that implements the call. So I will now proceed to the process of the open call for proposals. So the current open call will conclude a month from now on 15 October 2021. All projects received by that date by the Secretariat at the electronic address of the Common Fund for Proposal, or at the office address if for whatever reason it has to be submitted in hard copy. All project proposals will be read by one of the project managers. The project managers will undertake the screening of project proposals. That means that after reading the project proposals, the project manager will complete a basic checklist where they have to indicate if the project proposal meets the minimum essential criteria for consideration by the CFC. This is a one-page list that checks, for example, that the project activities are in a member country, that the project activities are relevant to the CFC mandate, and so on. So each project proposal received by the CFC will be given such a checklist. And with this checklist, the ones who are qualified will be considered internally by the CFC, by the CFC appraisal committee, including the chief operations officer, the project manager, and a few members of staff, the portfolio and risk manager, the impact manager of the CFC, to make a decision on the projects which qualify for submission, which are sufficiently well prepared to be submitted for consideration by the Cfc Consultative Committee. And this is the second big step in considering the projects: evaluation by the Cfc Consultative Committee. The Cfc Consultative Committee is a group of 9 experts appointed by the executive board of the CFC, who are acting in their personal capacities, not as representative of member countries of the CFC, and in their personal capacity as technical experts. They will review the projects passing the screening stage to make a decision whether they can be recommended for approval by the executive board. Their decision is based on the technical soundness of the proposal, on the quality, clarity, on the knowledge of the commodity sector as given in the project proposal, on the understanding that the project team has the competences required to deliver, to implement the operations as suggested in the project proposal, and so on. The experts of the consultative committee represent countries, and they represent different commodity sectors. So there are people there who are deeply professionally involved, for example, in coffee. Some people are deeply professionally involved in grains and in other commodity sectors. Some people are involved in commodity finance, so they're real sector specialists who will see if the project proposal is sufficiently well prepared and if there's enough competence at the level of project implementation to make this idea of a project into reality. If it is so, then the consultative committee will make a recommendation. The recommendation includes a few elements. Firstly, the recommendation will say that the project is recommended for consideration of approval by the executive board of the CFC. Second, most project recommendations include a list of preconditions. That is, things that need to be addressed, confirmed, verified, checked, etc., before the project is to the executive board for consideration of financing. So, after the consultative committee is concluded, the Secretariat will reach project proponents to address all those questions. And the CFC Secretariat, for those projects recommended for approval, will prepare a term sheet, a draft term sheet, with the conditions of how financing will be provided and what kind of financing this is going to be, and what kind of obligations will be expected from the proponents as the draft term sheet. Once the draft term sheet is accepted, the proposal is ready to be considered by the CFC Executive Board. And the Executive Board will make a decision. A calendar is later on the slides where there's a date. The Executive Board makes a final decision whether the CFC will get involved in financing this project proposal. Now, the normal question that we expect is, so what does a project need to do to pass through these consideration stages? Just to give you an indication, we receive 100 plus project proposals in each call for proposals. Out of those, between 5 and 10 go to the consultative committee. And after recommendation by the consultative committee, provided that all comments by the consultative committee have been addressed, the rejection rate in the executive board is relatively low. I would say 80% plus projects recommended for approval by the consultative committee are approved for financing by the executive board. So in the end, we aim to finance about a dozen projects per year. So what does a project need to provide to be one of those 12 or 10 or 5 projects? Well, firstly, do have a look at the goals of the CFC. As I was explaining them in the very beginning of the presentation, the project needs to be clear that it is contributing to sustainable development by addressing some very specific, very clearly identified issues in the commodity sector. Like, for example, the contamination of coffee with mold produced by smallholder farmers, which makes this coffee unmarketable, and so on. So this is a practical example of one of the past projects. Also, the track record of the applicant needs to be clear. We simply need to be able to show to the executive board that the team proposing the project is qualified and has the necessary experience and competence to implement the activities of the project as intended. Normally, it is the track record, it is a few years of past operations in this or relevant commodity sector. Also, it is appreciated if the project is clear and logical, and if it's well written and carefully. It simply makes the job of the executive board easier to understand the proposal and to come to agreement that this proposal is worth the attention of the CFC. We cannot avoid requesting carefully prepared financial information, because the financial sustainability is the foundation of the longer term sustainability of the project. And if the financial projections are not accurate, if they are not convincing, then we simply cannot talk about the sustainability of the project, no matter how nice a model, no matter how nice an idea is underlying the project. Without financial sustainability, the project will not achieve the sustainable results in this area where CFC is operating, in the commodity value chains, because commodity value chains, obviously, they're part of the global markets. Something that is not financially sustainable will not exist after the CFC financing is withdrawn. And it is clear preference of the CFC member countries that the projects need to exist after the CFC financing has finished. Finally, it's a matter of understanding the proposal. All the assumptions, all the projections need to be clearly stated. So, for example, if we assume that the market for organic vegetables in Europe will continue growing at 5% per year, this simply needs to be stated, and then it will be fairly easy for the executive board to understand where the project is coming from, what is the opportunity that the project is seeking to exploit. So, as I promised, this is the calendar for the 19th open call for proposals. So by 15 October, we expect to receive the applications. Then into mid-December, we will be screening the applications. Then we have to submit the documents to the Consultative Committee 1 month before the meeting. That means by the end of December. And then the Consultative Committee will make a decision from 24 to 27 January 2022. After the Consultative Committee, we will reach out to those project proponents whose projects have been recommended for the approval by the Executive Board. And we will ask them to address any points raised by the committee and agree on the draft term sheet, aiming to submit those project proposals to the Executive Board in April 2022. Yes, we do have a number of project proposals which, after recommendation by the Consultative Committee, did not manage to address all the recommendations made by the CC, and they're still pending in our pipeline, awaiting amendments by the proponents before they can be submitted to one of the future meetings of the Executive Board. We do not give up easily on good project proposals, and as long as there's progress being made, we will wait for a while. If there's progress, then we will wait and aim to submit this project proposal to one of the future meetings. After the Executive Board has decided, we will communicate to all successful project proponents regarding the next steps. And this is the subject of the next slide as well. What happens once the proposal has been approved by the Executive Board? It is important that up to the Executive Board, most of the CFC assessment is based on the information provided in the application form. That is, we take the word of the proponent for the truth and accuracy of all the information provided in the application form. If the Executive Board approves the proposal, we will check that it meets any conditions given by the Executive Board. The Executive Board might ask, for example, for some additional financial indicators or for some additional impact indicators. So we will have to have a confirmation that those indicators can be provided. We will proceed with due diligence to verify all the claims, all the statements, all the facts provided to us in the application form. So this is the stage where we'll check that the application is accurate and can be confirmed on the ground. During the COVID crisis, it has been difficult for us to travel to different locations to verify this. But at the same time, we do not consider suspending the operations a suitable option. So we proceed with the local consultants. We recruit local consultants, specialists who do not need to travel to do their due diligence work for us. And my colleague will be able to explain more about it in a few moments. So before we can disburse the money, we will need to conclude the legal documentation, conclude the term sheet, carry out this on-site due diligence, write the contracts, confirm the security pledges for CFC financing, and once the contract is signed, then the CFC can make disbursements under the conditions specified in the project loan agreement. We do expect that the projects start within 12 months after approval. We do not like to carry a long list of projects which are gradually moving through all the legal documentation for years before we can start implementing, because this keeps our resources tied up for projects which are not operating. So if the project fails to launch within 24 months after approval, after 2 years after approval, which we consider plenty, then the CFC Executive Board will consider withdrawing the CFC commitment to provide financing for the project, known as the sunset clause. Okay, so this part concludes the process of considering the project proposals. And now we're going to go chapter by chapter through the application form. And if you have any questions, then please don't hesitate to ask. I will start with part 1, the general information about the application. That's fairly simple. And I will, in a few moments, give the floor to my colleague, to Axel Gruber, to talk about the project and financing. So firstly, we require the statements that basically the person submitting or the organization submitting the proposal is clearly identified, that whoever puts the signature on the proposal is authorized, that it's a member country, that there is a voluntary obligation to remain in compliance with all applicable in ESG, environmental, social, and governance regulations in the country, that there's no litigation pending against the proponent, and that all the information provided in the documents is true and accurate. So this is the first page of the application form. Summary information about the project proposal makes it easier for the Consultative Committee and the Executive Board to understand what the project is about. And it includes the basics, the place where the project will operate, in which commodity, what it is approximately going to do, how this is intended to be financed, what's the experience of the proponent, and if there are any competitors, who else is operating in the same field, in the same commodity chain that can interfere with the proposed operations. The package of documents includes the application form that is, by decision of the CFC Executive Board, may not exceed 20 pages. So this is a hard constraint. If application form itself exceeds 20 pages, then the Executive Board can refuse to consider this. Aside from that, we expect financial projections provided in Excel. The template is downloadable from the CFC website. We also expect as annex to the application form the background information about the proponent, the financial results, preferably audited financial reports of the proponents for the past 3 years, background information on the key individuals, any evidence of registration and good standing, for example, tax records, the tax certification, evidence of relevant partner relations, for example, co-financing agreements, co-financing arrangements, or any kind of guarantee arrangements with partners, and evidence of collateral or any other risk mitigation facilities available for CFC financing. So all combined, this is a package that goes with application form. And now we can proceed to the request for financing, where I will invite my colleague, Axel Gruber, to take the floor. So firstly, a brief summary, the forms of financing, and then we'll go in detail on what's there. Axel, please go ahead.
Yes, thank you, Andre. So let me jump directly into the typical forms of financing. The CFC, since its reform in the year 2012 to 14, is primarily intervening through term loans, which normally are in the range of 300,000 to 1.5 million. Up to 7 years with a maximum of 2 years grace period. So this would even account for shorter term financing. So if we have a financing that would elapse for working capital, for example, within shorter period of times, we may grant a longer term credit line via this kind of financing. We would look for collateral if there is CapEx, so capital expenditure, equipment, assets are financed, and would not leave this alone. This question comes up once in a while, and we would accept or even would look for under the circumstances to be explained in the proposal for third-party guarantees if required. Normally, the interest rate is between 5 and 10. The system of our interest rate is based on the country. So the base rate is the country funding rate, because we could not finance a project under the level where a country would fund itself in the markets. And then a markup for the individual status of a project is chosen. I may say we are assessing each project, since the CFC is doing this based on an internal risk scorecard where we evaluate the different elements of the risk, and these would finally lead to a certain interest rate. I may say that in the average of the CFC portfolio, this is across all countries, across all projects, our funding rate for the time being is roughly 7%. Including different kind of collateral arrangements, including different kind of guarantees, including all the different kind of countries where the CFC is investing into. So it's an average of it all. Yeah. So the conclusion for an individual transaction needs to respect this. Trade finance is something we added, especially with a higher intensity during the COVID crisis, because we were envisaging a stronger need for short-term financing as the value chains were interrupted. And there was a strong increase of this kind of intervention during that time, and still is. If you look into international value chain financing, you would find that this is the major constraint for the time being. On the other side, the crisis, the COVID crisis, has decreased investment plans for many projects and many companies, and has rather made them concentrate on their given business and inside them to keep these value chains up, and not to look too much into expansion. Nevertheless, there are some projects which look for expansion still, but the majority of interventions during COVID has been on the shorter term financing side. There is equity stakes which the CFC has been allowed to take, but only in funds so far. And there is another instrument, the development impact bonds. The CFC has intervened into one before, and we are currently trying to implement another one, and we are almost done. In short, a development impact bond combines the impact of a project with the obligation to repay. Most of the time, there are different partners involved where, depending on the level of achieving the impact indicators, the repayment rate is different and will have to be substituted by one or the other partners. It's complicated because it's not a bilateral financing. Most of the time, at least three, maybe even a fourth partner will be involved, who is the one to evaluate on the impact and to assure that the impact indicators agreed in front of the instrument conclusion will have been met. It is an interesting instrument as it combines what the CFC formulates in its mission to have financial interventions to assess projects and companies based on their financial performance, but to respect as a second level of assessment a reasonable explanation and a reasonable transparency on the impact a project would like to achieve locally. And it is the mission of the CFC to look at, are there any new jobs generated? Is there local income generated? Is value addition generated through a commodity? And is a project respecting environmental standards measured by licenses, measured by activities undertaken in the sector of ecological agriculture? And so this development impact bond is so interesting for us as it combines the two in a financial framework. In all the other projects, it is respected, but it is not reflected in the financial structure itself. There are some fast tracks which we use. Fast track means it should indeed be implemented faster than others. Most of the time, this is we have used this instrument before, all again for our ELF, which is the emergency liquidity financing, which we established in the process of COVID. But the fast track requires some pre-assessment and some pre-approval of the counterpart, because the fast element cannot omit a thorough and transparent assessment of the counterpart. Maybe next page. Yes, it is important, the share of financing by others, and I may explain what I mean by this, needs to be, or the CFC share should not exceed 50%, which means there is another 50% by other participants, which could be other organizations funding the same operation, and contribution by the counterpart through its balance sheet, through its equity participation, through own funding, so that the CFC is not overexposed to a single project. These sources of financing must be shown in the financial projections and in the documents being submitted. The duration, I said up to 7. The normal duration being shown has been shorter, up to 3 to 5 years. Why is this the case? Because we need to look at financial plans, and in many instances, given the circumstances of projects, any projections beyond 5 years are purely difficult to be made. You may see this in your own projects. So this is quite difficult, and as such, the evaluation of repayment capability beyond a term of 5 years is quite difficult. The interest rate, I've already explained this. There's the base rate of the country, and there is a project-related risk assessment. Equity finance, I've already said something about it. And if CFC invests into equity, it's always a minority stake. So CFC doesn't want to get into majority stakes wherever it is investing into. Yeah, this is what you would find in the documents. It refers to the same a loan amount between 300,000 1.5. We've seen applications higher than this, and they are not formally excluded. This is more a recommended range, but in certain cases we've exceeded this amount of 1.5 million. To undercut the 300,000 is very difficult for us, because the implementation effort the CFC needs to make and the workload which comes to the CFC as part of its internal management structure is not different if a project is 300,000 or is 1.5 million. So we are facing, sometimes we are facing objections on the volume of implemented projects. If it's too small, our cost will not change. I may have to say that the cost of the CFC is borne by what we call the first account. So the cost of implementation and for the counterpart is paid before, so to speak. So we do not charge a component of the margin for the internal implementation cost. Pretty important to mention. Yeah, the co-financing I mentioned, we have the 50% rule. So we cannot exceed the financing by more than 50% provided by CFC, period. I've already elaborated on this. Collateralization we search for. In some cases, it's not possible, because the cases we can see that we run into an operation, a company that has already granted all its collateral on others, especially on land. It's a very popular way of other financiers. Once they start financing, they occupy, I may even say they use this word, they occupy the overall collateral structure. So we have to look for mitigating factors in such a case. In the short-term financing so trade finance, working capital finance, trade pre-finance, we normally do not use this kind of collateral. In certain cases, we may recall on collateral on stock, but pretty difficult to manage. There are some cases where we managed it. All depends on the project, if it is elaborated enough, or if the overall management structure of a company is elaborated enough to have clear control on the stock management via silos that are verified, or via a collateral agent that would assess the value of the collateral at certain point in time, and who would be the owner of the key. More important. So what goes in and what goes out would be assessed by this third-party verifier. This is not the case in very small and very early projects. So for them, it's normally not the case. So we have to look for other ways of circumventing that. A difficulty, the collateral, so the formal collateral on land or on machinery or equipment normally goes in line with the local registration of the collateral, which is again time consuming and in some countries overly costly. So we sometimes have to compromise. We cannot compromise everywhere. If the risk structure of a project calls for it, we may not be able to shy away from it. We may be able to substitute it by some kind of guarantees and other kind of mitigating factors. The fast track I've already spoken about, mainly used for such projects that have already been pre-approved. as an emergency intervention for, in cases where, for example, to maintain an operation where quick money is required. A project requires prepayment for smallholder farmers to go on with its operation. And in the COVID crisis, as I said, on the emergency liquidity funding, we have been working on that basis.
This slide is relevant.
Yeah, this is relevant. This is the emergency liquidity facility. We've been using that for a number of projects during the crisis to avoid interruption of their value addition, and especially to avoid the purchase of produce from the smallholder farmers, who would be in a pretty difficult situation if this off-taker would not be able to pre-fund.
Mm-hmm. Yeah, and maybe a few words about equity financing. That's mostly in impact investing funds.
Yeah, the CFC in its after the implementation of the new rules has asked the board for being able to invest into some kind of funds which were doing the same as the CFC, but where the risk diversification would be much higher for the CFC. And on top of that, the CFC has learned quite a lot and has even started some cooperation with these funds to beef up and to develop the operation of the CFC as such. This is more an internal remark, but the CFC started this business in loan-based interventions only a few years ago, and operationally a lot of techniques needed to be developed, not to make this an endless process. I think we've become pretty reactive and pretty fast in implementing this, and our cooperation with the funds has been quite useful for many of the target projects we were intervening into.
Okay, so Axel, that was the part for summary of the financing for projects. Next part regarding the project description, I will say a few words about it, and then we can have a look at the layout of the Excel spreadsheets for financing. So you will see all those sections in the application form. So this is just a summary of what is there in the application form. First, the operational model. What is the company going to do? What is the project going to do? There's a specific limit of 700 words because every operation, every business is so complicated that it can take pages and pages to explain it. The CFC needs to understand how the project will change the life and the operations of a company for the better. And the project obviously implemented within a limited time frame with limited money, how it will take the company from where it is now to where it wants to be in 5 years. The operational capacity is the explanation why the management of the project is competent and capable of operating it both at the operational level and at the financial level. Simply put, accounting the money, that the company has the experience in managing its financial flows in a way that make the company, the organization, the operation, that make it sustainable in the financial terms as well as in operational terms. The CFC prides itself on its ability to finance innovative projects. That is, the projects that do not fit in templates of, for example, banks or larger agencies. And that means that we always give preference to projects that demonstrate the clear focus on innovating in commodity value chains. So any element of innovation, anything that the project is doing fresh, new, original, needs to be explained in the proposal because that greatly enhances the chances of the project receiving the approval of the executive board. We cannot avoid asking for competitive challenges because commodity markets are competitive, and there's always things that can go wrong due to external and internal difficulties that the operation may experience. This is why we're asking to provide a SWOT matrix, the strengths, weaknesses, opportunities, and threats to the project operation that the project proponents are aware of. The CFC positions itself as impact investor, and that means that the very important part of the application form is the assessment of impact that the project will have in terms of sustainable development goals. The CFC operates in sustainable development goals framework, and it needs to be explained how the project will contribute to the SDGs. There's a small explanation in the application form on assessing the net economic impact. There's also a spreadsheet in the annexes, which you can complete to explain the economic impact of the project. For example, 10,000 farmers will make extra $10 a month. That will be attributable to the project operations. That's the net economic impact. Sustainability of the project model, also in terms of the alternative occupation, for example, for the farmers. So the farmers who will be growing maize in the project, maybe they could be producing something else, and given the choice, they would be producing something else that would put the sustainability model of the project under threat. Or, for example, if the project is using non-renewable resource, that the project requires excess water utilization, that needs to be addressed as a sustainability challenge of the project. We require basic information about the poverty profile of the end beneficiaries and the social impact of the project. For example, a mining community that is critically dependent on exhaustible stocks of minerals available for small-scale mining might as well benefit from development of farming activity, and that will create social impact in terms of changing the community structure and in terms of increasing its resilience to, for example, weather shocks or food price shocks. And that also can contribute to the environmental impact of the project. The CFC will have to monitor and evaluate the achievements of the project. So any existing or available monitoring and evaluation arrangements will be appreciated and will help the project reach the approval state. And the key impact indicators. There I will have to show a few more slides on the impact. Starting with the core sustainable development goals of the CFC. These are 4 SDGs, and that is SDG 1, fighting poverty, SDG 2, ending hunger, SDG 8, decent work and economic growth, and SDG 10, economic development, economic growth, eliminating discrimination, etc. In addition to those core SDG targets, there are 2 supplementary targets also looked at by the executive board. That is gender lens, because that applies across the whole commodity value chain. So how the project will address gender equality in the commodity value chains is a very relevant part of the project impact. Same SDG 13, climate action. Commodity value chains do have a very high impact on the climate, and a project in the commodity value chains needs to explain how this will help or how this will address the climate challenges. In the annexes, there's a sample of the spreadsheet that you may wish to provide with the application is just a sample of the indicators that you may want to include to show how the project addresses those sustainable development goals. The CFC uses IRIS metrics. This is clearly available on the internet. It's very complicated. There's a lot of indicators. It's not complicated, but there's a lot of indicators. So we do not want to make the life of project proponents difficult. That's why we are proposing a selection of indicators from the IRIS metrics that are fairly easy to complete, and that will allow us to have the comparable assessment of the impact of a particular project in the context of the overall portfolio of projects receiving CFC financing. So for us, clear impact indicators are very important. The calculation, this is the example of calculating the net economic impact of the project. As I mentioned, we need to identify the beneficiary groups that get the economic benefits from the project, and we need to assess the magnitude of those benefits and how the project will change the lives of those beneficiaries by creating jobs, by increasing income, by diversifying income opportunities, by increasing their resilience, and so on and so forth. And that can be expressed in money terms. And this is the place where assumptions are very important. So in preparing the project proposal, please don't forget to include the assumptions which underline all those projections, all those expectations. We have already talked quite a bit about the sustainability. So these are the examples of sustainability challenges from the standpoint of the beneficiary of the project. So if the beneficiary gains from the project, we need to see how the beneficiary will continue gaining from the results of the project after the CFC involvement has concluded. Samples of indicators explaining the poverty profile of the end beneficiary. This is also a section in the application form. Please use the publicly available data to indicate how the potential beneficiaries of the project rank in terms of their poverty in the context of the country, for example, where the project is operating, or in terms of the region. Environmental and social impacts. This is all the elements that will change in the society hosting the projects as the result of project implementation. So the CFC has a particular approach of requiring that projects at a minimum are environment neutral. That is, projects with negative environmental impact are normally rejected by the CFC at the screening stage. If there's positive environmental impact of the project, then the CFC Consultative Committee will count this positive as a plus for the project and will enhance the ranking of the project in making a recommendation to the executive board. Also, if there are environmental risks known to the proponents, those risks need to be identified and mitigation measures need to be suggested to make sure that the project does not fall in the category of negatively affecting the environment. IRIS metrics applies, and when the project comes to the implementation stage, the CFC will apply its policy, its social and environmental risk management system, which is simply a system of indicators that the project will be expected to report on to make sure that its environmental and social risks remain within reason, remain within limits that can be mitigated. This will come after the executive board approval. So the next section speaks about the financial viability of the project. So there we have the overall summary. the references to financial projections. And then I will show separate slides, the financial ratios of the project, the financing structure of the project, the financial model of the project. And then I will invite Axel, if you would like to say a few words about that. Axel, microphone.
Yeah, no, absolutely. I simply wanted to give you the chance to have a short break. Financial viability is a core form of assessment, as it is the impact of the project itself. So we need to have a look at the financing structure and the additionality of CFC financing within this financing structure. We look at the past financial track record, and I may say at this point, most of the projects we are funding and we are receiving are projects presented by a company. So we do not need to assess the project by itself only, because in many cases a single project being funded on itself may be weaker than a project being brought forward by a company that has a financial strength by itself. So the project is always something that is embedded into the financial structure of a company that itself is applicable to ask for financial funding. As such, the past financial track record within a company could show a distinct financing background for even a new activity within that company. And as such, the whole project needs to be assessed in that context. We are looking at the past financial track records. That means what has been the turnover, what has been the achievements in the years before, and what's the cost structure as to the income structure. A project does not need to be necessarily profitable, but needs to show a clear sign that cost and income is under control, and that there is a clear tendency that this structure is survivable, is sustainable over time. Companies that work under capacity, so could have a much higher turnover, much higher revenues based on the same cost structure, show a distinct advantage to those that are working at full capacity and still do not make a cost coverage in their operation. So we have to look at this. The financial projections are important. We need, although working about the future, they are important based on the assumptions that are being made. So why are the revenues going to grow at a certain rate? Hopefully not at a hockey stick planning, which just says next year everything is going to double or triple due to some, and then the reasons have to be outlined why this is going to be the case and how realistic that is. Same applies to pricing of the commodities or the value addition that's being produced. So reasonable price assumptions are necessary. And the CFC has gained quite some experience on pricing, not only in world coffee markets, where each of us can pick the prices at the Chicago Commodity Exchange or at whatsoever exchange, but we are pretty well aware of the local prices being paid and need to be paid to make living for the farmers sustainable, and to still offer enough of a potential for the off-takers and aggregators to keep their operation sustainable. Exit strategy, that's a point. Is this operation going to go on, or is it depending on CFC support forever? You may say companies depend on third-party financing even beyond the project is ending. That's absolutely right. So in any operation, there is a certain level of third-party financing necessary, but it's all about Here, it's all about the capability of an operation to repay at a certain extent and to potentially come back. But it's all about the way that the operation is able to make sure that the financing that has been built up can be repaid as well. Risk mitigation is pretty important. There are risks that can be mitigated through arrangements, guarantees, etc. But be all aware, in the sector we are working, there are some risks we all have to take, and that's the weather risk. You would could be insured at reasonable rates to be found out, but and price risks of commodities, and we see this after, for example, again, coffee, after some years of having a relatively downward oriented prices, we see a price stabilization right now, which is a good information for the farmers. But is it sustainable? Yes, sounds like. But in other commodities, we could face the opposite as well. So the price risk on commodities, which is part of our operation, can hardly be mitigated easily. Okay, you could say there are futures to buy, yeah, but you could not mitigate this risk in the long term. You could mitigate it in the short term, but for the long term operation, it's a risk that needs to be borne, and we need to assess to what extent is an operation still sustainable, even if some price risk arise and this operation needs to go on. Yeah, we are looking at the financial ratio, the equity ratio. We would find in sound operations to be at least above the 20%, if not higher. The leverage ratio, we see operations that are heavily indebted and may have hardship to deal with the indebtedness further on. The CFC, and we all know if the interest burden is too high, the operation may be strangled by a too high level of debt. What's the solution? There needs to be other forms of financial support by increasing equity, by finding new investors on the equity side. We've seen a number of operations that even during our financing have seen higher debt rates, and at the end needed to find new investors on the equity side, which happens. This is not something that cannot be done, but the level of external debt needs to be controlled, because if the interest burden eats up the company as a whole and the operation as a whole, it's not a recommendable project at the end. As such, the interest coverage ratio, this is what I was referring to. To what extent is the cash flow of a company able to cope with the interest that it has built up? And I don't speak about is the interest high or low. I speak about the level of debt that even with a low interest rate can be an overburden for the company. So we need to look at this, and we need to make sure, is this company soundly financed, and can an additional project be borne by the company as such based on its financial structure?
So maybe Red wants to say a few words about the model.
Yeah, this is a typical it's a pretty simple model, because the structure of organizations and companies we work with is not so complicated. So we look at the sales cost of goods sold. That is the cost for the company, a gross margin that can be achieved. There is sometimes other operating income. The gross income is the sales minus the costs associated to the sales. Personal costs, very important. Marketing and sales, if they are. Most of the time, these three categories are not soundly managed. So marketing costs may be in personal costs, administrative expenses may be in cost of goods sold. This is a little bit for us to make, because the personal costs, if they are permanent and do not relate to the sales that are done. So a company, if having too high fixed costs on the personal side for overhead, may have difficulties to cope with a decrease in the goods sold. Then there is the EBITDA, which is a measure which we are looking at, earnings before interest, tax, and depreciation on assets. This is a measure to see if a company in an ongoing operation can do operationally well. And then comes depreciation. That is not a cost, but that's an accounting term. And then you can see here the interest rate, the interest expenses. So a company can be operationally well off, but can be strangled by the interest expenses. And we need to separate these two views to make sure that we understand the operating model. This means this company is doing operationally well, but is over-indebted and may have to take distinct steps to increasing the equity, which would not, and equity does not build up instant interest rate cost at the same time. There's the profit before taxes, income from grants. We see that sometimes that companies still have some grant payments for certain projects. It's doing, if a smallholder structure is developed, in many cases it may need to be funded by grants, because the building up of a network of only 3,000 smallholders is not something you can achieve easily in the run of the normal business operation. So we are looking at that as well. Is there some arrangement? And there are many organizations who are really helpful in that, which we see and who we cooperate with. And the exceptional income line is: are there any participations, or is there a sales of assets that has contributed to the income, which is definitely not something that can be recurring. So you can sell your assets only once to support an annual income statement, but it will not be a recurring one. So that's I want to give you a little bit the reasons why we are doing this, because we need to get really an insight, and if this is properly filled, we already have a good picture of where the operation stands and to what extent an additional project can be borne by this operation, with all the costs and all the efforts being associated with it.
Yep. Thanks, Axel. So we're almost done with the presentation. There's a couple more simple slides, like the financing structure. So as we mentioned, it is going to be financed not only by the CFC, but by other co-financiers. So this is the financing structure. So who else is there and how this financing is organized?
Andre, I may have to add that we are showing a balance sheet as well to be filled in, to understand that how this financial structure is changing over time. I don't want to go through the details, just to make sure, because understanding a profit and loss statement is almost impossible without having a balance sheet. And we are asking for, at best, the company has a 2 to 3 year record on audited financial statements, because only by audited financial statement we have certain security that these numbers are properly maintained.
Yep. So that's the model balance sheet is included as part of the recommended package for submission, and also Excel model can be downloaded.
I may add here that many of the projects that do not have somebody who is either accounting equipped, so accounting has an accounting background, or even a CFO managing the financials of the operation, we see difficulties in maintaining all this. And it's not about having the formal requirement. It's about all these management elements that are included into that role, that somebody produces the transparency within a project, but as well sets the right management decisions to keep an operation in a sound financial structure. The absence of such people in projects is not a good sign.
Yeah. Yeah, good. The rest of the application form, the remaining information about the proposal, and that's basically concerns. We want to know who is behind it, the organization, what type of the organization this is, how this is registered, for how long, the contact person, how we can reach the person, and obviously where the people have found out about the call for proposals. I don't think this needs much of explanation. So this concludes our prepared presentation for this session, and we are now open to questions. You might simply unmute your microphone and ask the question. If that is difficult, you can type your question in the chat box. I'm opening now the chat box to see if something comes in, and we are at your disposal to answer any questions you might have. Thank you.